New York, Washington, and Main Street, USA are all feeling the tremors. Behind the bright lights of Wall Street and the soaring stock indexes, something darker is brewing. America's credit market, the lifeline of businesses, families, and even the U.S. government itself, is showing signs of dangerous cracks. And experts warn, those cracks could soon turn into fractures. The warning signs nobody can ignore. Credit is the engine oil of the American economy. From credit cards and mortgages to corporate loans and government bonds, trillions of dollars depend on smooth functioning. But fresh data shows the gears are grinding. Delinquencies are rising. Credit card debt in the U.S. has hit record highs, and the percentage of people falling behind on payments has surged to levels not seen since the 2008 crisis. Mortgages, once rock solid, are also slipping, with more households struggling to keep up with their monthly payments. Consumers are buckling. Inflation, sky-high housing costs, and punishing interest rates are pushing families to the breaking point. According to reports, subprime auto lenders are collapsing, and low-income households are getting crushed by repossessions and bankruptcy filings. Private credit stress. In the shadow banking world, the $1.7 trillion private credit industry, Bank of America is flashing red lights. More loans are going bad, more companies are asking for payment relief, and defaults are climbing. Analysts call it a slow bleed that could turn into a gush. Wall Street's doublespeak. Publicly, banks and credit rating agencies still talk about resilience. But read between the lines and the story is starkly different. Moody's just downgraded the U.S. credit rating, warning that America's ballooning debt is no longer risk-free. The U.S. Treasury faces a $9 trillion maturity wall in 2025, meaning it must roll over staggering amounts of debt, all while paying higher interest rates. That's like refinancing your mortgage every month at a higher rate, forever. Meanwhile, the cost of insuring U.S. debt with credit default swaps, Wall Street's version of a fear meter, is creeping higher. Investors are quietly hedging against the unthinkable, a U.S. default or deeper credit crisis. Corporate America is not safe either. The warning isn't just for households. Companies too are feeling the pinch. Moody's estimates default risk among U.S. firms at over 9%, the highest since the Great Recession. Business development companies, once darlings of the credit boom, are reporting rising non-performing loans. Some borrowers are now paying interest not in cash, but in more debt, a desperate move called payment in kind. And in the auto industry, the pain is already visible. Parts manufacturers and subprime lenders are going bankrupt, sending shockwaves through supply chains. The big question, is this 2008 all over again? That's the trillion-dollar question. The official OFR Financial Stress Index still shows markets are calm. Stocks remain buoyant, and the Federal Reserve insists the banking system is stable. But cracks always appear quietly before the dam bursts. In 2007, Wall Street said subprime mortgage losses were contained. A year later, Lehman Brothers collapsed, and the world plunged into the worst financial crisis in modern history. Why this time could be different and worse? Unlike 2008, the stress today isn't confined to mortgages. It's everywhere: consumer credit, corporate debt, and even U.S. government bonds. The entire system is wobbling at the same time. Add political gridlock in Washington, with shutdown threats and no credible debt reduction plan, and the outlook darkens further. If investors lose confidence in America's ability to manage its debt, borrowing costs could spiral out of control, triggering a chain reaction from Wall Street to Main Street. The takeaway: the cracks are real. Families are defaulting, corporations are wobbling, and America's own credit reputation is under fire. The Federal Reserve can't cut rates fast enough to solve the underlying problem. The country is addicted to cheap debt, and the bill is finally coming due. This isn't fear-mongering. It's reality. The only question left is whether the cracks stop here, or whether we re-standing at the edge of the next great credit crisis. Don't forget to like, comment, and subscribe for more breaking financial stories. Turn on the notification bell so you never miss the news that could shape your wallet and your future.